So you spent 20, 30 years, maybe even longer building your business. And now you've sold it or in the process of selling it. And you probably have more money in your bank account than at any other point in your life. Most business owners I work with say that selling their business feels exciting, terrifying, and exhausting all at the same time. But it's not time to rest just yet. What you do in the next 6 to 12 months will likely determine your financial security for the rest of your life. Here's exactly how to think through it. First, make sure it's enough to retire if that's what you want. If you plan to retire, figure out your income needs and expenses. There isn't one client I work with that already knows how much they spend every year. And for business owners, it's harder because you also need to unwind expenses that are personal that you have been putting on your business and figure out what you'll need to pay out of pocket going forward. So it's important to work with a financial advisor to run projections to confirm that you're on track to live the lifestyle you want in retirement because the proceeds from the sale of your business may not be enough. Many people are surprised that how much they need to retire on depends on expenses, not savings. For example, you could sell your business for $20 million, but if you need to spend $2 or $3 million a year, it may not last that long. So as you consider the best ways to utilize the proceeds, remember that spending drives what's possible. Also consider new expenses that are coinciding with the sale of your business. I don't think I've worked with one exiting business owner who didn't buy a new house or a second home around the sale of their business. So tally up any major purchases or new business investments that you'd like to make, as well as any major charitable or family gifting goals, because you'll want to understand what you're working with. Cash at close is king when selling your company, but major purchases can erode your top line before you know the bottom line. Remember to plan for various holdbacks, escrows, earnouts, and think about all of those things when considering how much money you could actually walk away with and the timing of those payments. Perhaps you did an installment sale and you don't have all of that money up front. So before you can decide what to do with the cash after selling a business, you also need to figure out what the after-tax proceeds will be. The tax consequences from the sale can be highly complex, especially if you were doing business in multiple states. Unfortunately, especially in those highly complicated situations, it can take months to sort out. So it's important to not pre-spend the proceeds. When working with exiting business owners, we will do a comprehensive financial plan for them, but we usually wait until the deal has completely closed. As I just mentioned, even when the deal is done, there can still be a lot of unknowns. A comprehensive financial plan can address your income needs, your cash flow needs, major purchases, and account for market volatility at the same time. To feel confident that it isn't too early to retire and that you're not going to run out of money, a Monte Carlo simulation is key. It takes into account hundreds of different trials using different expectations of risk and return to stress test a retirement plan. And once the deal closes, we always recommend reviewing goals, assess feasibility, and consider trade-offs if you need to. For many business owners, this is going to be a once-in-a-lifetime liquidity event. Don't discount the emotional transition. Going from a CEO running a business every day to suddenly being retired can be a really abrupt transition, both mentally and financially. The idea that this is all I'm ever going to have. We've seen a lot of business owners have a lot of financial stress around this time, even though it coincides with a windfall. So I highly recommend not gifting or spending money too quickly after selling your business and before you truly know you can afford to. So consider any time-sensitive tax planning opportunities with this lens. After selling a business, you need to figure out what the investment strategy is going to be. As a business owner, growth was probably your top priority. As the transaction is now complete or nearing completion, you need to figure out ways to protect and grow the wealth that you built. When you're thinking about how to invest a large cash windfall, it can be very stressful. Again, many business owners have been investing in their business versus the public stock and bond markets. And that can be unnerving for new investors managing what is usually their life savings. It's important to consider whether you should partner with a fiduciary investment advisor. One strategy when we are looking to invest a large sum of cash is dollar cost averaging into the market. This is the idea that there's short-term market volatility all the time. But that doesn't mean that you can sit on the sidelines in cash, because cash will erode with inflation and you won't be able to meet your lifestyle needs and goals. To smooth out the natural volatility in the markets and to help stay on track when there might be emotionally charged responses to things that are going on, putting a certain amount of money into the market over a period of time is a great way to go from cash to fully invested. Perhaps it's a certain dollar amount every month or week. Usually we recommend completing the reinvestment process within 12 months. We really do recommend doing a phased approach to investing the market versus just being a price taker on one day. This helps smooth out short-term market swings. It makes for a better investment experience. And importantly, it really helps business owners stick with the plan. Another thing that's really important on the investment side is determining what your income needs are and the timing of upcoming liabilities. We often use treasury ladders, so there's always a bond maturing to meet those needs. We do the same thing with large tax bills for quarterly taxes, and then of course in April, or if you're on extension. This is a great way to keep cash safe while earning some return, and it's exempt from state income tax as well. Another important thing to do on the investment management side is revisit risk. Discuss your risk appetite versus capacity. You don't want to take on more risk than you need. But again, being potentially a new public market investor, you might not be aware of what the natural volatility is. Having been invested in your business, you can control that more so than when you're investing in the public markets. So it's important to walk through how markets have moved historically so you know what to expect. Consider the pros and cons of a bucketing strategy and whether it makes sense to split different risk profiles across accounts or perhaps different trusts, with the idea that you have a sleep at night bucket that's invested much more conservatively than perhaps money that needs to last you for 20, 30, who knows, 50 years if you're considering an early retirement. Also consider different tax optimization techniques. After selling a business, cash will go into a taxable brokerage account or a taxable trust rather than a retirement account. So being tax efficient is really important. One component is direct indexing. So in this example, you would buy the underlying stocks of an index instead of the index in an ETF or mutual fund. The idea is that while the market on a whole, we do expect to go up over time, the performance of the individual securities within a certain index like the S&P 500 will vary extensively every year. So if you could sell one of those stocks and harvest a loss and use that as a tax asset while staying invested and substituting it with a similar security, that can build tax assets and offset gains. This is a great way to harvest losses. Of course, as with anything, there's a lot of caveats and considerations, and you'll certainly want to consider how aggressively losses should be harvested because you don't want to sacrifice long-term growth for tax savings today. Typically, a direct indexing strategy provides the greatest tax savings the first 12 months after the initial investment. So depending on the timing of the sale within the calendar year, this strategy could be a great thing to consider at the beginning, but it isn't just limited to the year of sale. Also consider concentration risks. Depending on the nature of your exit, and if you did rollover equity or if you still have an earnout or perhaps you're still working for the business, you may still have significant exposure to a certain company or industry. So consider ways to diversify. This can be done through screens, direct indexing, and trading options. There's a number of different ways depending on your situation. Before you can decide what to do with cash after selling a business, you need to know what the after-tax proceeds are going to be. Calculating the taxes after selling a business can be really complicated depending on the nature of the deal. So make sure to work with your tax advisor and financial advisor to understand the implications, especially before you're allocating proceeds and making major purchases. You certainly don't want to be surprised with any major tax bill or lock up too much liquidity in the purchase of a new home. You can only spend $1 once, so it's critical to have the support from a professional team when deciding what to do with the money from the sale of your business. As a business owner myself and having navigated an exit with my father, I understand what business owners are going through, and I've helped them navigate this transition successfully. So if you've recently sold a business or in the process of exiting, speak with us today. My name's Kristin McKenna, and I'm the president and wealth advisor at Darrow Wealth Management.